Hello, my name is Sandy Liang, and I'm the lead bond and income portfolio manager for Purpose Investments. I'd like to spend a few minutes of your time to deliver an important message about today's investing environment. It concerns interest rates, and not just how they're going up, but how they've already been going up and have been on the rise since bottoming in mid-2016. At the same time rates are going up, economic growth is healthy, not just in Canada, in the US, but globally as well. There are two important trends in place today: rising rates and strong, coordinated economic growth worldwide. After we talk about these two trends, we will talk about what this means for your investments and what we believe is the best way to optimize return versus the risk you're taking in this investing environment. First, let's talk about interest rates. They are on the rise. That is fact. In the past 12 months, the Bank of Canada has raised the overnight lending rate it charges banks 3 times, from 50 basis points, or 0.5%, to 1.25%. As an indirect result, mortgage interest rates are also on the rise, where the posted 5-year rate is 5.1% in Canada, up from 4.6% in early 2015, according to the Bank of Canada. For the first time since the early 90s, Canadians who are renewing their mortgages are beginning to see higher monthly payments. In the US, short-term rates have also been on the rise. Since December 2015, the US Fed funds rate has been increased 5 times, from 25 basis points to the current 1.5%. We think it's reasonable to believe that the Fed funds rate will increase another 2 to 3 times in 2018 alone. The action is not just in short-term interest rates. Longer-term interest rates are on the rise too. For example, the 10-year Government of Canada bond yield bottomed in mid-2016 at under 1% and has recently been 2.4%. South of the border, the 10-year US Treasury started this year at 2.4% and was recently 2.9%, a move of 0.5% in less than 2 months. The US rate is up from a low of 1.4% also in mid-2016. So the question is, how did interest rates get so low in the first place? And what does this mean about rising rates from here? Since the Great Recession that followed the credit crisis in 2018, the most influential central banks in the world, the US Federal Reserve Bank, the European Central Bank, and the Bank of Japan, have engaged in something called quantitative easing. In order to try and stimulate economic growth and inflation, they've been buying government bonds and other types of bonds from investors, increasing money supply, and at the same time driving down long-term interest rates by making these bonds more expensive. Remember that bond yields move in the opposite direction of bond prices. Most recently, the central banks have been spending as much as $150 billion a month buying bonds from investors. Initially, it was just the US Fed that started its QE program in response to the credit crisis. However, in mid-2015, the European Central Bank got involved in response to the Eurozone debt crisis. Meanwhile, the Bank of Japan has accelerated its QE program since 2015 to drive its bond yields lower. The amount of QE that has come out of Europe and Japan has far outstripped the amount from the US. The result is that, collectively, they were successful in driving interest rates lower, to the point that as much as a third of the world's government debt had negative interest rates in 2016. Think about how ridiculous that is. Negative interest rates. Rates are still negative in some European countries, especially for short-term debt. The world's central banks basically made money so plentiful in 2016 and 17, the world experienced the lowest interest rates in the history of mankind. So it's no wonder that financial and real estate asset prices rose. The values of bonds, stocks, and real estate are indirectly tied to interest rates. I would also add that because of easy money policies, many other perceived stores of value have gone up in value at the same time, including fine art, collectible cars, and cryptocurrencies such as Bitcoin. While the world's central banks successfully drove interest rates lower, this period of easy money is now coming to an end. interest rates around the world are now going higher as economic growth and inflation rates begin to normalize. The US Federal Reserve Bank is reversing its support of the bond market by shrinking its balance sheet and giving bonds back to the market. In Europe, the ECB has committed to reducing its QE program in late 2018. In Japan, the BOJ has quietly been reducing its open market bond purchases. As a result of the beginning of the end of global QE, interest rates are already going up. This is most obvious in the US with the 50 basis point increase in the 10-year Treasury bond yield this year to date alone. Why is this period coming to an end? Because the central banks are on the verge of saying, mission accomplished. That is a good thing. The world's economies have recovered. For example, the US economy is at full employment. The number of people making first-time unemployment claims is the lowest it has been since the early 1970s, when there were a third less people. In Europe, economic growth in 2017 was actually faster than it was in the US in the same period, and the fastest it has been since before the credit crisis. Last month, the New York Times reported a story with the headline, "Every one of the world's big economies is now growing." I quote the article, "Every major economy on Earth is expanding at once, a synchronous wave of growth that is creating jobs, lifting fortunes, and tempering fears of popular discontent." As a result of this synchronized global expansion, this business cycle is on firm footing. Corporate earnings are growing, especially in the US, where there is now the benefit of lower corporate tax rates. Less companies are going out of business. This is a favorable environment for lending money to corporations because they're more likely to pay you back with interest. Which brings us to our final topic, how to navigate this environment. First and foremost, try and minimize interest rate risk in your portfolio. Interest rate risk, or the risk of bond investments going down in value because of a change in rates, is more worrisome right now than credit risk, or the risk that a company won't be able to pay you back. As an example, let's look at a simple Government of Canada 10-year bond. If the 10-year yield goes up another 1% in the next year, which is not far-fetched at all, because look what's happening in the US, then this bond will lose you 5% of your investment value even after the interest you receive. Of course, we're not concerned that the Government of Canada will not pay you back. However, your 2027 bond that pays you a 1% coupon rate today will be worth even less money in a year. We would much rather lend money to corporations today for a shorter period of time than lend to the government for a long period of time. In fact, we think that because of the synchronized global expansion, corporate credit quality is continuing to improve, so it's better to take credit risk than interest rate risk. In the history of the high-yield corporate debt market, it's always outperformed its more interest rate sensitive counterparts in periods of rising rates such as we have right now. For example, in 2013, there was a rising rate scare as the US was winding down its QE program. In that calendar year, long-term treasuries in the US with maturities more than 20 years lost investors 13%. Midterm treasuries with maturities 7 to 10 years lost investors 6%. However, the US high-yield corporate debt market made investors a positive return of 6% in that same period of time. Over time, corporate bonds have less risk than stocks because as lenders, the bondholders are entitled to get paid before the owners, who are the stock investors. In our income funds, we're focused on taking less interest rate risk in favor of credit risk to produce returns for investors. By acting as a lender to companies, our funds benefit from the overall improvement in corporate credit quality and increasing earnings as the business cycle is in a period of synchronized global growth. The result is our investment funds benefit directly from stronger corporate credit quality and higher inflation and interest rates over time. We understand that this period of rising rates is a new world for most investors. With our experience through past business cycles, we are here to help navigate this period. Thank you for listening today.